We are joined today for the hour by the firm's founder and chief executive officer, Jeffrey Gundlach. The markets, the Fed, the president, and all points in between on our menu over the next 60 minutes. We now welcome in Jeffrey Gundlach. Thank you for having us once again.
Yeah, welcome, Scott. Welcome to DoubleLine again.
Yeah, it's good to be here on this Fed day, the final Fed day of the year.
Yep.
What do you expect today?
I think I saw on CNBC yesterday there was a survey, and the result was unanimous. 100% said the Fed isn't going to do anything, and I have nothing to add to that because that seems absolutely positively correct. The Fed is going to keep rates unchanged and probably have a message that they are kind of encouraging inflation to go higher. One of the most important statements that I think has gotten less play than it should is Jay Powell said in late October. He said that we would have to see a significant rise in inflation that is persistent to even consider raising interest rates to fight inflation. So the Fed wants inflation to be higher, actually, and they've contextualized this by saying, well, 2% was our target for many, many years, and we fell short. So now we need to kind of fill the gap, which makes no sense to me whatsoever. I think it's cover for wanting interest rates to basically be below the inflation rate, which seems to be the game plan for central banks in developed countries really around the world. And so now we have the 10-year Treasury yield is below the inflation rate. The CPI is up at 2%. The core CPI is up higher than 2%. And yet the interest rates are being kept below that. So Fed knows that we have a debt problem in the United States and that the way to push it out, the day of reckoning out into the future, is to have interest rates below the inflation rate, which has been accomplished now by the Fed.
I want to talk to you about Jay Powell. Mm-hmm. You said the other day that you'd give him a C- if you were grading him, and you likened him to a losing NFL football coach. How's that fair?
Well, because Jay Powell 12 months ago had a framework about what his outlook was for 2019, a basic framework about viewing the world. And that framework was quantitative tightening on autopilot, regardless of economic data, and successive interest rate increases during 2019. And 3 weeks later, it was exactly the opposite. So it's difficult to give him a lot of credibility in the messaging because of the U-turn that was taken. And instead of raising rates successively in 2019, we've cut rates 3 times in 2019. So a very different playing field for 2019 than what we expected. I think the one reason that I'd give Jay Powell a C- and not a D is that he has said, and I'm not sure we can believe him because we couldn't believe what he said last December, he has said that to fight the next recession, he does not believe negative interest rates are a good idea in the United States. And I applaud that as loudly as I possibly can, because I think negative interest rates in the United States would really be a problem for the global financial system. He has said he will do large-scale asset purchases to fight the next recession, which means, obviously, a quantitative easing program. So what we are looking at is an environment where the next recession, I believe, left alone to market forces, long-term interest rates would probably rise. But Jay Powell, I believe, has told us, if we can believe him, because he changed his mind so quickly after his December statements, but he's told us that he will control long-term interest rates to fight the next recession through quantitative easing.
What's wrong if he simply realized, and the Fed realized, that maybe they made a mistake by raising rates last December?
Nothing's wrong with realizing they made a mistake.
The playing field, using your language, changed, perhaps. There's the trade war, there are tariffs. Actually, he's had to manage his way through all of that.
Yes, I suppose. You're being kind of generous. I mean, when he did the quantitative tightening autopilot statement and the successive interest rate increases, the risk asset markets were already having trouble. It wasn't like that suddenly him saying that led to the decline of over 20% in the stock market and the closure of the junk bond market, where there were 2 months where you couldn't even float a new issue junk bond in the fourth quarter of 2018 because the market was closed. This was all because of what the Fed was doing. And yet it was when the market finally flushed out down in late December where the apology tour came out. So I think that what happened was the Fed thought they had a framework that was working. The markets threw a temper tantrum about it, and they were forced then to go back to basically the Fed model that we've had for quite a few years now, which is following the market rather than, I mean, the great Paul Volcker just passed away this week at age 92. He was the one that really had control over what the interest rates were and wasn't just listening to the market. And I wish that if the Federal Reserve has a purpose, it should be to have an outlook and follow it regardless of what the market does. And instead, Jay Powell capitulated and went along with what the bond market has said. And now the bond market's completely in sync with the Fed. I mean, you have Fed funds rates, the same basically as the 2-year Treasury, which is kind of the same as the 5-year Treasury, which means that the Fed is now comfortably on hold. But what Jay Powell has done is he raised rates 4 times and in 2018, then cut rates 3 times in 2019. We basically have gone nowhere. We've just put ourselves on kind of a wild ride, which I believe was unnecessary.
Are you against the concept and the idea of an insurance policy? Because that's what it was. It was taking out an insurance policy unless things got bad because of the trade war and other issues, be it geopolitical or otherwise. You can throw Brexit into that stew and the uncertainty of knowing where all of that was going to play out. What's wrong with an insurance policy?
Why did you raise rates 4 times in the first place is my reaction to that. There's nothing wrong with adjusting policy, and you can call it insurance policy, you can call it mid-cycle adjustment if you want to. But it doesn't seem to me that there's much chance of the Fed really following through on this mid-cycle adjustment concept, because that would mean that we're going to raise rates again. Yet Jay Powell in October said to raise rates, we need a substantial increase in inflation that is persistent. So even if inflation goes up, what they're telling you is there's no intention of raising interest rates unless the dynamics change pretty remarkably. So all we did was raise rates 4 times just to cut them 3 times. We should have just left them alone the whhole time, is my opinion.
Do you think he should be replaced? I mean, he's taken fire all year long from the president.
No, I don't think he's any different than what you would replace him with. I think the Federal Reserve has turned into a body that is essentially following the market. And now the bond market is saying there's no purpose in raising rates, so they're not going to raise rates. There's no purpose in cutting rates. And so we're probably going to be on hold for quite some time. The bond market says that will probably be unchanged interest rates until maybe the 3rd quarter of next year. And that to me is what's motivating the Fed.
Labor market's pretty strong. The economy's pretty good. Stock market's at record high.
Well, yeah.
Some would look at that and say, you know what, the Fed has somehow managed to do its job pretty well.
Well, some people give credit to the president, too. But you're on the labor market. What's interesting is people keep talking about how great the labor market is, and it's good for sure. But the job growth under Trump for 3 years is less than the job growth of the last 3 years of Obama by about 10%. It's about 10% less. So that's not any better. What's better is people aren't getting laid off. That's what's better about the labor market. Weekly unemployment claims are really low. They're at about 200,000 right now, which is the lowest tick in a long, long time. They're down by about 30% from the last 3 years of Obama. So in the last 3 years of Obama, job growth, payroll growth was pretty good, but people were getting laid off to the tune of about 300,000 per week. Now it's down to the low 200,000. So that's a pretty big drop. So that, I think, is why the economy is perceived to be better on the jobs market, because the labor force participation has increased. It was under a steep decline for many, many years. And starting in about 2016, in the last year of Obama, it finally started to improve. And I think that's the good thing that's going on in the economy.
I mean, you yourself have taken down your recession expectations.
Absolutely.
To like 35.
That's right.
Almost half of what you predicted when we last spoke.
Well, I don't know if that's when we last spoke.
Well,
in the summer. It was really in August.
Well, the point is, you're not expecting a recession anytime soon now.
I think that it's unlikely to be a recession at this point. The odds are against a recession occurring before the end of 2020. And what's happened is consumer confidence has really held up. And the year-over-year leading indicators from the Conference Board were at 7% year-over-year 15 months ago, which is really strong. And you have never had a recession in the last several decades without leading indicators first going negative. So that's really the canary in the coal mine. You have sometimes had negative leading indicators without a recession, but you've never had a recession without negative leading indicators. So it's a necessary and not sufficient condition. So leading indicators are low right now, year over year. They're around 0.4, but the numbers that are rolling off for the December-January period coming up are quite low. And so our forecast is that those will improve in the next couple of months, which makes it very unlikely that we'll have a recession, say, in the next 6 to 12 months. So it's down about 35%. In the summer, don't forget that there were white papers being released on Wall Street encouraging the Fed to do an inter-meeting 50 basis point emergency cut. That's how bad some of the manufacturing data was getting globally. There's a little bit of improvement in that as well. So the recession outlook would really depend. To forecast the recession at this point, there's two things you have to watch. The consumer view of the present would have to deteriorate, and it's still pretty high. And you'd have to see those initial weekly employment claims going up to about, well, they have to go up probably from 203 or so thousand where they are now to probably 250,000. And there's no reason to believe that that's going to happen.
How do you foresee the trade war playing out? I mean, you could have more tariffs on as early as a handful of days from now. Is that potentially impacting your perspective and point of view?
When it comes to the trade war, I've been consistently stating that there will be no trade deal until the 2020 election. There's absolutely no reason for China to do a trade deal on the terms that the United States wants when there's an election coming up in less than a year, and potentially they could have somebody else that is more old school and wants the genie back in the bottle and would take the tariffs away.
Are you talking about a full-scale trade
Yeah, I'm talking
deal?
a real trade
So you
deal.
could have a phase one or phase two or
Phase
whatever
one.
you want to call it.
The phase one thing was really something. I mean, it was a private language. It came out of nowhere. Some Friday afternoon, all of a sudden, we have this phase one trade deal. Looks to me like it's more like phase 0.1 trade deal because nothing is happening. That's just rhetoric to try to make it look like there's progress happening. I think the phase one trade deal day, that press conference was the low point in Trump's presidency. I thought that was really almost shameful because we had never talked about phasing a trade deal. It just came out of the blue, and he said something about 50 billion tons of soybeans being bought by China. And then I learned on Monday, I got a white paper from an economic consulting service, and they said that actually what China agreed to was thinking about buying some soybeans 2 years from now. So that doesn't sound much like a trade deal to me. The real nub of the issue is really a problem, and that's the intellectual property. And China doesn't want to do anything on intellectual property theft, and that's probably the most important thing from the United States' point of view when you think longer term. And so for that reason, what's really important in the trade deal is intellectual property. That's not going to happen, and that's why we suddenly came up with this kind of escape hatch, which was this phase one trade deal, which I think is just nothing. And I don't even think there's going to be anything resembling a substantive trade deal before the election. I felt that all year. I remember back in May, we were talking about the tariffs were going to be removed. It was like May 10th or something. The tariffs were going to come on, and it was like, oh no, they're not going to come on, but they did. I just think that this is something that is a long-term problem. We're not going to see a solution thanks to the fact there's a presidential election that's contested in November.
This idea, the repo market, what's gone on there throughout the balance of the last few months, since September, really?
September 17th was a day where there was tax payments and there was a bunch of bills being issued that were in excess of the bills maturing. So there was a little bit of a liquidity problem. September 17th. What's interesting about that is the repo market, the overnight repo market, had been struggling to stay in line with the Fed funds rate, but that day, September 17th, it just blew out. In about an hour, it went up to about 10%, and the Fed sort of had to panic and come to the rescue by adding reserves to the system. That, to me, is a worrisome development because it suggests that the market doesn't ratify the Fed funds rate. The Fed has the Fed funds rate at a level that really isn't clearing the market in a free market way for overnight money. And what they're doing is they're adding reserves to try to counteract that. That corroborates my viewpoint, which I think is a minority opinion, that in the next recession, if the Fed doesn't do quantitative easing, and Jay Powell has said he will, if we can believe him, and he doesn't have a good track record on believability, but in the next recession, the amount of bonds that would be issued at the long end would be so horrifically high that I think interest rates in a normal free market clearing mechanism would rise, and rise fairly significantly. And that's what the repo market is kind of telling us. On September 17th, overnight money was over 2%, and the 10-year Treasury was below 2%. It's really telling that you can't find buyers for overnight money in excess of a 2% interest rate, and yet the 10-year Treasury is below 2%, with inflation at 2% and higher. It tells you that the interest rate levels that are being maintained by the Fed really are not market levels, they're manipulated levels. In the next recession, right now, the national debt is growing at over 6% of the economy. So $1.27 trillion was the growth in nominal dollars of the national debt in fiscal 2019 that just ended. That's more than the growth of nominal GDP in dollars. In other words, all of the growth of the economy in nominal dollars has been the growth in the national debt. We're at 6% national debt growth is consistent with the depths of recession with Keynesian stimulus. When the next recession comes, it is likely that the national debt will go up to double digits growth, which would mean bonds being issued in the many trillions of dollars. And I don't think the interest rates would clear at that level without the Fed getting involved with quantitative easing. So the Fed is kind of on the case here. They understand what the problem is. They understand that we have a debt compounding problem and that interest rates would get completely out of control and lead to a mega recession. Imagine if in a recession mortgage rates went up, what that would do to the economy. But the Fed, I believe, will counter that. And what they're doing with the repo facility being increased is kind of proof positive that they are manipulating interest rates and intend to do so in the next recession.
Credit Suisse makes what some have termed a stunning call yesterday, calling for QE4 by the end of the year to deal with stresses in the repo market.
Are they doing QE4 already? They say they aren't, but the balance sheet has already taken back 40% of the quantitative tightening that was done during 2018 into the early part of 2019. So they're already expanding the balance sheet. It's already back to over $4 trillion. They don't call it QE because I guess technically it's growing the repo facility and not buying coupon bonds. So it is different from what they did during 1, 2, and 3. But I mean, stylistically, it sure looks awfully similar. You're adding stimulus liquidity to the system, which is helpful. I mean, that's one of the reasons why I think the risk markets have had this second wind. I think if the Fed had executed on their program that they were talking about 12 months ago, we'd be in horrific market conditions. It's just that the market broke the Fed's resolve.
So then, given everything that we've discussed since we started the conversation at the top of the show, where are interest rates going in the near term? Okay.
The short rates are staying the same, and I think that that's perfectly corroborated by the shape of the yield curve. I mean, Fed funds are basically 1 5/8. The 2-year Treasury's at 1 5/8. The 5-year Treasury even is very close to 1 5/8. So interest rates are going to be on hold for the Fed for sure. And again, I can't emphasize enough that October statement by Powell, where he said we're not even considering raising interest rates unless we see a substantial and persistent rise in inflation. When you hear that the Fed is cheerleading inflation higher, and our models show that the CPI is going to be 2.5 in a few months, and our model has been incredibly accurate, almost to the basis point. What that says is that the path of least resistance for the 10-year is higher interest rates, until such time as the Fed manipulates it lower.
How high? Like what's the level on the 10-year that you're willing to go out on?
I think that the 10-year now is about at 183 or so, and it looks to me like there's some pretty good yield resistance at about 205. That should be what contains this move up from 140. But there's a potential, I think, for if there's economic weakness, there's potential for something that resembles an echo. I'm not sure it would be as robust, but potentially an echo of the taper tantrum. Way back in the middle of 2013, we had a 150 basis point rise in the 10-year in 6 weeks. That's simply because Ben Bernanke said we're thinking about tapering our quantitative easing. I kind of think that if we get economic weakness along the way, which I'm not expecting in the near term, you could see a move back up to 3.25 on the 10-year, and I think that would get the Fed back into quantitative easing 4. So Credit Suisse might be right, but I don't think they're going to be right in the next 3 weeks.
Okay, so in terms of that forecast and how we should be positioning ourselves as investors and those who are watching the program for actionable ideas from you today, you urged investors should start, quote, playing defense now. What does that mean?
Well, what I said in my September webcast for my total return fund, I said I think we've seen the low in the 10-year for the year, and the 10-year was about at 150 at the time, and that was the case. So you should be playing defense relative to interest rate risk, because interest rates at the long end, the path of least resistance, absent the Fed going into QE4, is for higher, I think, longer-term interest rates. But when I'm talking about playing defense, what I'm really talking about is credit risk. Because credit risk, to me, right now, is very dangerous. There's a whole cocktail of fundamentals that I think lead to wanting to be early on exiting the corporate bond market. And I think the time to be exiting the corporate bond market is presently, because the corporate bond market is enormously bigger than it was prior to the global financial crisis. It was around $5 trillion then. It's $11 trillion now. And the corporate bond market is, I believe, misrated. There's a study by Morgan Stanley Research that I've been referencing now for quite some time. They've been doing this for quite a few years, that basically says, let's pretend that Morgan Stanley Research is a rating agency. And let's pretend that they're completely objective, but simplistic. So all they use is leverage ratios of corporations' debt in assessing what their rating should be. Morgan Stanley Research Department says that if you simply use leverage ratio, that 39%, fully 39% of the investment-grade corporate bond market should be rated junk right now. Imagine that. They're not rated junk right now because they're being a little bit lenient, I believe, relative to their downgrade system at the rating agencies. But if 39% of the corporate bond market would be downgraded to junk, you would see some pretty horrific movement. Against a backdrop of corporate debt to GDP being at an all-time high, and the leverage ratios of net debt to EBITDA in both the investment grade and the junk bond market are at all-time record highs. So spreads are extremely narrow in corporate bonds. In fact, they're narrower than people think. People look at historical charts. They go back several decades and they say, how much extra yield do I get from investment-grade corporate bonds versus treasuries? And the conclusion you draw from that is it's kind of low by historical standards, so that raises a caution flag. However, the percentage of the investment-grade corporate bond market that's rated single A or higher is at an all-time low. It used to be 2/3 of the corporate bond market was rated single A or higher 25 years ago. Now it's 35% of that market. So the rating is actually worse. So the yield spread should be higher than average, not at near a low level. So that's a very bad sign. Also, there's a yield grab that has gone on because of yield starvation in Japan and Europe primarily that has caused tremendous buying of U.S. assets, particularly corporate bonds, because there's a yield there. If you look at the net investment position of the United States, it's collapsed over the past several years, with 49% of GDP value is the net negative investment position of the United States. So this is all foreign investment that's come in. Foreigners, you can understand, are buying U.S. bonds because their bonds are negative. If you're an insurance company in Europe, what are you going to do? You can't buy bunds at negative 20 basis points. That's just a sure money loser. So what they're doing is buying U.S. assets, and that's helped the U.S. market. It's helped the U.S. corporate bond market. But the problem is that if you buy the corporate bonds as a European insurance company, if you hedge the currency risk back, so you buy the dollars and you hedge them back into euro, guess what happens? You have a negative yield. You have a yield that's even more negative than the German 10-year Bund. So you can't hedge it. So what's been happening is European investors, insurance companies and the like, have been buying U.S. corporate bonds and not hedging them. And that's one of the reasons the dollar has held up, because they're not hedging it back. So there's incremental dollar demand. The dollar has been stable for sure this year. The Dixie index started the year at 96.25. I didn't look at it today, but it was at 97.5 or so yesterday. So it's basically unchanged. But the dollar should be falling based on two things. The first is when the Fed is easing, it's highly correlated to dollar weakness because, of course, the interest rate is less attractive. Also, when the twin deficits, the budget deficit and the trade deficit, are rising as a percentage of GDP, which has happened for sure in the last few years, it's highly correlated to dollar weakness. The dollar has held up because of this naked buying by foreign investors who are yield starved thanks to the negative interest rate policy. What you have to think about is what happens if the dollar actually starts weakening and or corporate bond prices start dropping. You're going to see a huge loss start to develop in these naked dollar holdings for these entities. And my belief, based upon 35 years of experience and how investors behave when they start to experience losses, is they will then start to have waves of selling.
They run for the exits.
Right. And so this is why I think you're supposed to be playing defense. I believe this is almost like 2006 relative to some of the over leverage in some of the, the civs and all that stuff that went on that caused the global financial crisis. It really doesn't matter if the problem happens today or a year from now. You're picking up a tiny amount of money in excess yield, and yet the downside flush will be such that you will see tremendous losses accruing. And I think that's the fundamental risk that faces investors, and it's all happened because of the cumulative effect of this now not short-term negative interest rate policy. I was in Europe in September, and I hadn't been there for a while. And I was really struck by how the mood had changed since the last time I was there. The question used to be, well, we have to suffer through, how do we suffer through this temporary policy of zero or negative interest rates? That's off the table now. Now the conversation in Europe, at least from the large pension plans that I spoke to, was, what are we supposed to do? We're stuck with this forever, almost is the mindset. Should we take bonds, these negative yielding sovereign bonds, just out of the efficient frontier analysis altogether? Should we even forget about bonds as an asset class? In our pension plan, I said, well, negative yielding bonds, yeah, I think you should forget about them. But so that's what I mean by defense, is that the consequences of these policies are building up. And when the dam breaks, it's going to be a pretty big flush down. It's not worth picking up 50 basis points today when you're going to be losing 30 or 40%. In bonds, you make money slowly and you lose money quickly. You
know that there are going to be people listening to this saying that Gundlach and others have been making these dire predictions about corporate bonds and high yield for years.
Well, that's not true.
And you're saying, well, you'd rather be...
It's just not true that I've been making dire predictions about corporate bonds for years. It's just not true. I mean, I made dire predictions about corporate bonds at times over the past years, but those have been good predictions.
Okay, let's say at times. At times.
Well, look what happened in the fourth quarter of 2018. I mean, the corporate bonds were terrible.
But this is taking it to another level. Did I read you're looking at a?
I'm talking about it is another level. You're right. It's another level. It's a cyclical level. It's a fundamental economic level. There were problems in the past that had to do with sort of shorter term considerations. I'm really zooming back and thinking longer term. It was interesting. I gave a speech to a really big aggregator audience a few months ago, and the head of the thing said, "Let's do a fireside chat format." And I said, "That's great." And he said, "What I want to do is something a little different. I want to focus on like the next 6 or 8 years." And I said, "That's great, because that is exactly the way I'm thinking. I'm not thinking 6 months. I'm thinking by the mid-2020s, and I know that's not imminent, but by the mid-2020s, all of this is going to happen. And I think that the consequences of it happening are so substantial that that's the fundamental driver of how asset allocation policies should be set, just like in 2006, the idea was, or even 2005, the idea was, this nutty underwriting cycle that we've found ourselves in is going to end with such a catastrophe that you want to sidestep it, and it's fine if you're a year or two early."
Okay. I'm glad you put context on it. I think that's helpful for everybody to hear. This is not something imminent that you're talking about. You're talking mid-2020s.
Well,
and that's what causes the blow up is a recession.
It could be 2022. I mean, who knows? It could be 2021. I don't think it's going to be in the next 12 months, though.
You were saying about the gound?
Well, it was just something
as an art collector,
the crawler, and they said that the Princess Diana's gown went for $230,000, and I had to laugh because Catalan's banana went for $130,000. So a banana sold for the same level as Princess Diana's gown, roughly. I mean, in the same context. That banana is just genius stuff, I've got to tell you. I've got one hanging up over there, and it cost us 40 cents, I think. And Catalan sold them for $130,000. Best investment of the year.
Yeah.
He bought a banana and some duct tape, and it went up to $130,000 in a minute.
All right. Well, there's inflation, at least somewhere. So let's pivot and talk about politics, if we could,
Sure.
Because you'll probably get credit until the end of time for your prediction that Trump would win in
Before
16.
the primaries started, I said that.
Okay. So now what? What happens in 2020?
Well, the base case right now is Trump is going to win re-election. That's the base case right now, because the Democratic Party is kind of in disarray, it seems to me. I mean, you look at the polling, and we've been at this now for 9 months, 10 months or something like that since some of these candidates got in, and there isn't a single candidate that has captivated the imagination of the Democratic Party. You've got Joe Biden, who they say is durable because he's not collapsing in terms of his polling, but he's also not going up. If you're really going to be a front runner, you need to show some momentum. And Joe Biden has been basically at the same level since before he announced, really. And he just doesn't seem, it just doesn't seem like it would be enjoyable to watch the decimation of Joe Biden in a one-on-one debate with Donald Trump. I just don't think that he can formulate paragraphs the way he used to, and when you see him in the debates. So I just don't think that he's viable. And then you start going to the socialists, Bernie is also completely flatlined. Bernie's Bernie, you know what you're going to get. I give him a lot of credit for bouncing back from that heart attack. I mean, he came back and he was exactly the same guy 2 weeks after a heart attack. Got to give him credit for that. But there's nothing new there, and he isn't going anywhere in the polls. Elizabeth Warren, once you go from 52 cents to win $1 on Predictive, which is where she was a couple of months ago, to, I didn't look at it today, but I think she was at 14 cents at one moment yesterday. When you go from 52 to 14, you don't recover. It's over. So it's over for her. Then you've got Pete Buttigieg. Pete Buttigieg, when I heard that the mayor of South Bend, Indiana, was running for president, I literally laughed out loud. But then I heard him speak, and he is good. He is a great speaker. He's probably the best on his feet of any politician since Ronald Reagan. He is so good. However, he's so young. I just have a hard time believing you go from mayor of a city of 102,000 people. How many votes did he get when he won mayor of South Bend, Indiana? 20,000? Maybe 15,000? I mean, it's a big step to go from 15,000 votes to 60 million votes. And I just think he just looks so young. He's 37. He looks like he's in his 20s.
You're leaving out, of course, a big name in the newest entry
Bloomberg.
into the race, Bloomberg.
Yeah, he has no chance. I just think there's no chance there. I think that he right out of the gate has a lot of big problems. The first is I don't think mayor of New York City is a great credential for running for the president. New York is a unique place. It's kind of like Kamala Harris. They said, oh, she's senator from California, so that means that she's got a springboard. No, California is different from the rest of the country, and New York City is more like California than the rest of the country. And Bloomberg, with his stop and frisk, that's a problem. That's a really big problem. And with his regressive taxes on the poor for sodas and other manipulative types of behavior manipulation taxes, I don't think that's going to work. And also, it's tough when you're already late to the game. So I really give him very little chance.
Even with his $50 billion.
I don't think that's a positive. In the Democratic Party today, where vilification of wealth is a common theme, it seems like a delicious irony that one of the people that's running is the eighth richest guy in the world with $50-odd billion. It just seems so out of step with the tone of the party. I have a hard time believing it. I think the strongest Democratic candidate would be Hillary Clinton.
Now, you said that on the webcast yesterday. You were serious.
I am serious. She's the strongest candidate the Democrats have. That doesn't mean that she's a great candidate. It just shows the fractured nature of the party, and the consequences of that fracturing are a lot of. It's really two or three parties. It's very much the Democratic Party here for 2020 is very much like the Republican Party ex-Trump was in 2016. It was a whole bunch of kind of non-impressive candidates that were somehow trying to fit themselves into a mold without a real overarching ideology. I think that's sort of the problem there. So the base case really is that Donald Trump is going to win re-election.
Who are you supporting?
I don't support political candidates.
If the status quo remains and Trump does win, what does that mean for markets?
Well, it's probably more positive than him losing, I would say, because the rhetoric, the themes of the opponents certainly are probably anti-market. I mean, one of the questions, you mentioned my webcast yesterday, one of the questions that came up, someone said, is the market overreacting to Elizabeth Warren? And I said, what are you talking about? Elizabeth Warren is obviously not being taken seriously by the market. If the market was taking Elizabeth Warren seriously, it would not be at near an all-time high. It would be down substantially because she clearly would want to have anti-corporate policies. One of the reasons that the stock market did well under Trump, for sure, is when you cut taxes, you turbocharge the bottom line. Earnings go up on a net basis. Elizabeth Warren vows devoutly that she's going to reverse that, and so do many of the Democrats. So the market is actually telling you, I think, that the base case is Trump is going to win. And so that would continue to be a supportive aspect to the market.
Is that playing into where you think money's going to be made in the couple years ahead, expecting that Trump's going to win and then positioning therefore?
I think
because if you're worried about
buy the rumors, sell the news type of situation, I think the reality of the market positives for Trump are in the market. I think the market has absorbed those and believes in it. I actually think that much more than politics, I think what's really important for making money in a couple of years ahead is I think you have to start fundamentally believing that the dollar is going to get weaker. And I think you're supposed to orient your thinking around that, which means that foreign currency investments should be superior to U.S. dollar investments. I think that the dollar topped almost 3 years ago on the Dixie basis. It was at 103, and it's down at a 97 handle today. And I think that we go back and take really big picture views. My favorite chart of this year, we may have talked about this before, but it's worth repeating if we didn't, or even if we did. If you go back to the 1980s, so very long-term view, you divide the world into 4 regions: Japan, Europe, United States, and emerging markets. And something very interesting has happened. Over that 35-year or so period, there's been every one of those 4 regions has had a moment where they were world beaters. They were viewed to be invincible. First, it was Japan in the late 80s. It was invincible. The value of the Imperial Palace land, which is fairly small in Tokyo, was actually viewed to be the same as all of California. Japan was that strong. They were manufacturing everybody out of business. Remember? The Nikkei was by far the best stock market in the late 80s. Then the recession came in the early 90s, and the Nikkei was the worst market, and it hasn't been back since. 30 years later, it hasn't come close to that 1989 level. Then came the euro in the late 1990s. And there was tremendous enthusiasm. It would be a reserve currency potentially. There'd be a lot of cooperation. It was the ascendancy of Europe. And the European stock market was by far the best in the late 90s. Then came the recession in the early 00s, and it got kneecapped. Hasn't been back there since, 20 years later. Then in the middle of the 00s, it was a weak dollar. Emerging markets were strong with the weak dollar, and China was very much on the rise. And emerging markets were by far the best stock market in the world. Now what happened? Global financial crisis. Emerging markets got wiped out. They haven't been back since. Well, who's the world beater now? For the last 10 years, by far, it's the United States. The S&P 500 has blown emerging markets, Japan, and Europe totally out of the water over the past 10 years. That's partially because earnings have been better in the United States. It's partially because economic growth has been better in the United States. It's also because of financial engineering, which ties into that corporate bond thing, where you're able to get a lot of free money for corporations to do buybacks. It's also the tax cut. Well, my view is that this pattern will repeat, and that in the next recession, the United States will be the worst stock market in the world. The dollar will be weak, and I don't believe we'll get back to whatever highs put in again in my career, similar to what happened to Japan, then Europe, then emerging markets. So I think that's what you're supposed to be thinking about. And the linchpin to that thesis is that the dollar will be weaker thanks to the exploding deficits and the Fed going back towards zero.
I want to ask you about the mortgage market because
I like tips.
Yeah, certainly the way you sound today, we both like tips. But the mortgage market, the lion's share of allocation for taxable fixed income portfolio managers has been in the mortgage-backed security market. How am I thinking about mortgages in 2020 in the environment that you described? Because there seems to be a significant overweight to that.
I'm not really sure that I agree with that. I think that there's more of an overweight into corporate debt than there is into mortgage debt, although there are certainly funds like my total return fund, for example, that have a lot of mortgage debt. I don't really think there's an overweight there. Our analysis actually shows that mortgages are relatively cheap at the present time versus corporate bonds and Treasury bonds. So I don't really think that it's been an underperforming sector this year. The sectors that have really performed have been the riskier sectors in the bond market. Emerging market debt is up 12.6% year to date if you do it in dollar terms. and it's not much different in local currency terms. Corporate debt is shockingly high. Junk bonds are up over 12%, and investment-grade corporate bonds are up over 14% year to date, which is kind of amazing because Treasury bonds are only up about 7%. So my opinion is that mortgages have lagged over this interest rate decline thanks to prepayment fears. With the mortgage rates having fallen so much, with the 10-year Treasury dipping down below 150, we saw an increase in prepayment rates, which are problematic for mortgage-backed securities. So with interest rates going up a little bit since August, and my viewpoint, they might go up a little bit higher, the mortgage market is probably one of the better places to be in the investment-grade bond market right now, I think. So I'm not really worried about that at all. I'm much more worried, as we talked about with Scott, about the longer-term problems with over-indebtedness of corporate America and over-ratings in that sector.
You mentioned your total return fund. You have no corporate debt.
Never have. Never owned a single corporate bond. Now, we do own a small amount of the very top of the capital structure in CLOs, which are bank loan resecuritizations. But since they're at the very top of the capital structure, they don't really share the same type of exposure you would have down in middle-rated debt. So with that exception, we've never owned like an AT&T bond or any other sort of corporate name in total return bond fund. It's one of the ways that we basically have developed lower volatility over the many years because it's the lower volatility sectors. The corporate bond market's the higher volatility sector.
Steve Weiss, you have something for Jeffrey?
Yeah, so I'm curious about just our economy and our debt load. So the balance sheet, Fed balance sheet is back up to $4 trillion, which is where it was during the worst of times. Will there ever be a catalytic event that will cause the markets to care about it? Because right now the markets just don't care. We can add debt after debt after debt. And you as a bond guy and sovereigns, you're right in the heart of this.
Yeah, it's a really good question. You know, I see two parallel things that are kind of metaphorically equivalent that are going on that have to do with short-term considerations versus long-term considerations. One of them is the debt level of the United States, which is certainly a long-term consideration, but it's been talked about for so long, and it's never really been a problem yet. So we've glued many, many short terms together in terms of using a debt-based economic growth scheme. But eventually, when you glue a lot of short terms together, at some point it turns into the long term. And what's metaphorically similar to that is negative yields in Europe and Japan, particularly Europe, where they are trying to battle problems in the economy and try to get stimulus with negative interest rates, but they know that negative interest rates are ultimately fatal to the banking system. If you keep them forever, you ultimately end up bankrupting all your banks and insurance companies. So what we have is this odd world we're living in where we know that our policies in terms of the U.S. debt and negative interest rates in Europe are fatal in the long term. We continue to do them thinking that, well, over the short term, it doesn't matter. I really think that the big event that's going to make all of this start to become relevant and people care about will be the next recession. The Fed and the ECB and the BOJ are fighting an economic downturn with everything that they have, and they've been able to forestall it. But they can't forestall it forever. And when the recession comes, the debt to GDP will be so high, as I said earlier, that interest rates left to their own devices and market pricing would go up on the long end, I think, fairly substantially. So that's what we have to wait for, and the reaction to that will be some pretty shocking policies. I mean, we've seen shocking policies already through QE and negative interest rates and the like. And now we have candidates talking about free money. Andrew Yang has made the debate stage for the 7th Democrat. It's going to be on there December 19th. And his one policy is free money to people. And I think that will ultimately be the way out of our indebtedness. And that will cause inflation, I think, once we get there. So tips, yes, we like tips. Tips have done okay this year. I think inflation is being encouraged higher by the Fed. We'll probably hear rhetoric from Jay Powell in a short while that talks about wanting inflation to run hot. I don't know if he's going to use that word, but that's going to be the theme. And that's not exactly music to bondholders' ears.
We will hear what the Fed chair says. We have probably 30 seconds left. You got your 10th anniversary this week.
Unbelievable. 10 years of DoubleLine.
You got another 10 years in you?
Oh yeah. I've got 10 years in me for sure. I don't know about 30, but I definitely have 10. I want to see how this movie ends. I think that we're in what we call the fourth turning. There's a book by Neil Howe, Howe, called The Fourth Turning. I think everybody should read it. It's a kind of a political philosophy, a sociological philosophy, and it talks about how we have to go through a new building of institutions that people can buy into. Because right now, nobody's buying into the institutions that were set up in 1950. And we've got to get past that. It's going to be very, very interesting. And I hope to share it with your viewers on CNBC.
We look forward to that as well. Thank you once again for having us here at DoubleLine.
Thank you, Scott.